Your home insurance premium didn't go up randomly. It wasn't just inflation, and it wasn't just the market. Insurance companies use a formula, a risk model, to decide what you pay. That formula includes your home, your location, your history, and sometimes factors you don't even realize are being measured. In this video, we're breaking down how home insurance premiums are actually calculated and why they increase, even if you never file a claim. Insurance pricing is about probability, not fairness. The first thing to understand about insurance pricing is this: it isn't personal. It's statistical. Insurance companies don't price policies based on what feels fair. They price them based on probability, the likelihood that they will have to pay a claim in the future. Every premium is built around one core question: how likely is this home to generate a loss? And how large might that loss be? That calculation includes millions of data points across thousands of homes. Your individual policy is one tiny piece inside a much larger risk pool. This is why two homes that look similar can have different premiums. It's not just square footage or market value. It's construction materials, roof age, local weather risk, fire response times historical claims in your zip code. Even if you've never filed a claim, your premium can increase because the overall risk in your area has changed. Insurance pricing reflects collective experience. If storm damage increases regionally, premiums rise regionally. If building costs increase nationwide, premiums rise nationwide. Insurance isn't charging you for what has happened. It's charging you for what is statistically likely to happen next. And once you understand that foundation, the rest of the pricing model starts to make sense. The core factors that determine your premium. Now that we understand premiums are based on probability, let's look at the specific factors insurers use to calculate that probability. The first is replacement cost, not market value. Insurance doesn't care what your home could sell for. It cares what it would cost to rebuild it. That includes materials, labor, debris removal, and construction inflation. As rebuilding costs rise, premiums follow. Next is location risk. This includes storm and hail frequency, wildfire zones, flood proximity, crime rates, distance to the nearest fire station. Even a small change in regional risk data can shift pricing across entire zip codes. Then there's the structure itself. Roof age is one of the biggest variables. A newer roof often lowers risk. An older roof increases it. Plumbing systems, electrical systems, and construction materials all affect loss probability. Claims history also plays a role. Your personal claims record matters, but so does the claims history of the property and even the surrounding area. In some states, insurers also use a credit-based insurance score as a risk indicator. It's not the same as a lending score, but it can influence pricing. All of these factors feed into a risk model, and that model determines what you pay long before a bill ever reaches your inbox. Why your premium can increase even if you never file a claim. One of the most frustrating parts of home insurance is watching your premium increase when you haven't filed a single claim. It feels unfair. But remember, pricing is based on probability, not personal history alone. There are three major reasons premiums rise without claims. First, regional loss trends. If your area experiences more storm damage, wildfire claims, or rising repair costs, insurers adjust pricing across that region. Even careful homeowners are affected because they're part of the same risk pool. Second, construction cost inflation. If the cost of lumber, labor, roofing materials, or electrical components increases, the cost to rebuild your home increases. Higher rebuilding cost means higher potential payout, which means higher premiums. Third, catastrophic loss cycles. Insurance companies operate nationally and globally. A year of major hurricanes, wildfires, or severe weather events can impact company-wide risk models. Even if your town was untouched, your insurer may still adjust rates to reflect broader exposure. Premiums also increase when insurers reevaluate risk scoring models. If new data shows higher probability of loss in certain regions or home types, rates adjust accordingly. This doesn't mean insurers are targeting you. It means the underlying risk assumptions have shifted. And when the projected cost of future claims rises, premiums usually follow. Understanding this removes the feeling of randomness and replaces it with context. How your deductible directly affects your premium. Earlier, we talked about deductibles from your perspective. Now let's look at them from the insurer's side. A deductible changes how often the insurance company expects to pay. Lower deductibles mean more small claims get filed. Higher deductibles filter those out. That changes the overall frequency of payouts. And frequency is one of the biggest drivers of pricing. Insurance pricing isn't just about how expensive a claim might be. It's also about how often claims occur. When you choose a higher deductible, you reduce claim frequency. Fewer projected payouts allow insurers to lower the premium because statistically, they expect fewer small losses to process. But the premium discount isn't unlimited. Raising a deductible from $500 to $1,000 might reduce your premium meaningfully. Increasing it again from $2,500 to $5,000 often produces smaller incremental savings. There's a point where the math flattens. This is why insurers offer deductible options strategically. They want to balance affordability with risk retention. From a pricing standpoint, deductibles act as a lever. Pull it one way, premiums fall. Pull it the other, premiums rise. But just like we discussed in the deductible video, the key question isn't how much you can lower the premium. It's whether the premium reduction justifies the additional volatility you're accepting. Pricing always reflects trade-offs. And deductibles are one of the clearest examples of that balance in action. How claims history impacts what you pay. Now let's talk about something that feels more personal, your claims history. While insurance pricing is largely statistical, your individual record does matter. When you file a claim, insurers see two things: the size of the loss, the frequency of claims. Frequency often matters more than people realize. One large, legitimate claim may not dramatically affect your premium, but multiple smaller claims within a short period can signal higher future risk. From the insurer's perspective, past behavior is one of the strongest predictors of future behavior. If a property has generated several claims, the probability of future claims statistically increases, whether due to maintenance issues, environmental exposure, or simple pattern recognition. It's not punishment, it's probability modeling. Claims history can also follow the property, not just the person. If you purchase a home with prior claims, those losses may already be factored into the risk profile of that address. In addition, claims are recorded in shared insurance databases. This means switching companies doesn't erase history. This is why filing small claims can carry long-term consequences that outweigh the short-term payout. Insurance pricing rewards stability. The fewer claims filed over time, especially smaller ones, the more predictable your risk profile appears. And predictability is what insurers price most favorably. The role of your insurance score. In many states, insurers use something called a credit-based insurance score as part of their pricing model. This surprises a lot of homeowners. It's not the same as your lending credit score, but it's built from similar financial indicator. The reasoning is statistical. Insurers have found correlations between certain financial behaviors and the likelihood of filing claims. It doesn't mean someone with a lower score is irresponsible. It means, at scale, insurers see patterns in how risk distributes across millions of policies. The score typically considers factors like payment history, debt levels, length of credit history, types of credit accounts. It does not include income, race, or neighborhood demographics. And in some states, its use is restricted or prohibited. Still, where it's allowed, it can meaningfully influence premiums. A stronger insurance score can reduce pricing because it signals lower projected claim frequency. A weaker one can increase premiums, even if you've never filed a claim. This is one of the most misunderstood parts of insurance pricing. It feels unrelated to your home. But remember, insurers are modeling probability, not fairness. From their perspective, every data point that improves prediction improves pricing accuracy. Whether you agree with the practice or not, understanding that it exists helps explain why two similar homes can have very different premiums. And it reinforces the broader point. Insurance pricing is layered and not always visible on the surface. Why replacement cost keeps pushing premiums higher. Even if nothing about your home changes, one factor almost always does: the cost to rebuild it. Insurance premiums are tied to replacement cost, not real estate value. And replacement cost moves with construction inflation, sometimes faster than general inflation. If lumber prices rise, labor costs increase, or building codes become stricter, the projected cost to rebuild your home goes up. And when the potential payout increases, premiums follow. Many policies include something called Inflation Guard. This automatically adjusts your coverage limit each year to keep pace with rising construction costs. It's designed to prevent underinsurance, but it also gradually increases your premium. There's also something called Extended Replacement Cost Coverage, which allows insurers to pay above your stated coverage limit if rebuilding costs spike after a widespread disaster. That added protection increases pricing as well. And in recent years, large-scale weather events have driven rebuilding demand higher. When many homes are damaged at once, labor shortages and supply constraints push costs up even further. Insurance companies price based on what it would cost to rebuild tomorrow, not what it cost 5 years ago. So even without filing a claim, even without changing your deductible, premiums can rise simply because rebuilding your home would cost more today than it did last year. That upward pressure is structural, and it's one of the most consistent drivers of premium increases nationwide. Why market conditions can raise everyone's rates. Sometimes your premium goes up for reasons that have nothing to do with your house, your deductible, or your claim's history. It rises because of the insurance market itself. Insurance companies don't just absorb risk, they transfer part of it through something called reinsurance. Reinsurance is insurance for insurance companies. It protects them from catastrophic losses like hurricanes, wildfires, and large-scale storm events. When global disasters increase, reinsurance costs increase. And when reinsurance becomes more expensive, insurers pass part of that cost down to policyholders. This is why you can see rate increases even in years where your region had minimal damage. The broader market may have experienced heavy losses elsewhere. There's also the capital side of insurance. Insurers must maintain reserves to cover potential future claims. When investment returns fall or catastrophic losses deplete reserves, pricing models adjust to rebuild financial stability. Additionally, regulators approve rate adjustments at the state level. When insurers demonstrate rising projected losses, they request rate increases to maintain solvency. From the homeowner's perspective, it can feel disconnected, but insurance pricing operates within a national and sometimes global system. Your premium reflects not just your risk, but the health and stability of the entire insurance market. Understanding that broader context helps explain why rate increases sometimes occur across entire states at once. And it reinforces a key point. Not all premium increases are personal. Some are systemic. What you can actually control. After seeing all these pricing factors, it can feel like everything is out of your hands. Regional risk, construction inflation, market conditions, reinsurance costs. But you're not powerless. There are levers you can control. First, your deductible choice. Adjusting it strategically can lower premiums if it aligns with your financial situation. Second, your home's risk profile. Updating your roof, modernizing plumbing or electrical systems, installing storm shutters, or adding security systems can reduce projected risk. Third, your claims behavior. Using insurance for major losses instead of small repairs protects your claims history, which directly affects long-term pricing. Fourth, your coverage accuracy. Ensuring your replacement cost estimate is realistic, not inflated or outdated, helps prevent overpaying. And finally, you can periodically shop the policy. Different insurers weigh risk factors differently. A home that looks expensive to one company may price more competitively with another. You can't control national weather patterns or global reinsurance markets, but you can control how much risk you retain, how you maintain your home, and how often you engage the insurance system. Insurance pricing isn't entirely in your control, but it isn't entirely outside of it either. Understanding where you have influence is what turns frustration into strategy, and that's where we bring everything together. Final resolution and viewer takeaway. By now, one thing should be clear: home insurance premiums aren't random. They're the result of layered probability. Your home, your location, your history, rebuilding costs, market conditions, and broader risk models all working together. Some factors are personal, some are regional, some are national, very few are emotional. When premiums rise, it doesn't automatically mean you did something wrong. Often, it means the projected cost of future losses has increased, either for your property or for the system as a whole. But understanding how premiums are calculated changes how you respond. Instead of reacting with frustration, you can ask better questions. Has my replacement cost increased? Has regional risk shifted? Does my deductible still align with my finances? Is this still the right insurer for my profile? Insurance pricing isn't about fairness. It's about forecasting. And once you understand the forecast, you can make informed adjustments instead of guessing. If you want clear, practical explanations like this, consider subscribing so you don't miss out. This video is for educational purposes only and does not constitute legal, financial, or insurance advice. Insurance company practices, pricing, and regulations vary by provider and jurisdiction. Readers should review official policy documents and consult qualified professionals regarding specific insurance questions or decisions.